watching Stock Watch. I'm Zinated Kuman. Join me to unpack your stock-related questions today are Alex Duys from Umthombo Wealth and Shane Watkins from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or an X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. It's quite a busy time with the results season heating up on the JSE. And actually, it is the start of the fourth term, September, October. No. It's the last month of the third term. Just starting with you, Shane. I mean, as we start off this new month, how are you positioning yourself, particularly with all the news that is coming out on the JSE?
So, Zanati, the South African orientated companies, June year ends are reporting at the moment, and the two we've had very recently are Bidvest and Truworths. And I would say both of those have missed expectations. And, you know, the Truworths share has fallen from, well into the 70s. It fell into the 50s on Friday. It's trading slightly above 50. And the Bidvest results, I think, also disappointed the market because that share price was down sort of 3 to 5%. So I think companies that are reliant on growth in South Africa are struggling. It's only companies that have a self-help story, some kind of turnaround, or companies that are gaining market share that are really surprising on the upside. Otherwise, I think in general trade is tough, and this is evidenced by the results.
Yeah. I'm actually going to drill into those companies in a minute. But Alex, just as we're starting off with the new month and of course with all the noise that is happening in the macroeconomic environment, but also in terms of the company results, trading updates, how are you weaving through the environment at this point?
Yeah, it's difficult, as Shane says. I mean, South African companies are struggling. Economic growth is far below what we expected perhaps 12 months ago. And outlook still remains very difficult. So there is perhaps a couple of green shoots you're starting to see. I mean, if oil price remains relatively low, then perhaps the consumer can benefit. Slightly lower interest rates, of course, could also help. And some of the structural reform narratives takes time, and perhaps we'll see the benefit of that starting to eke through early next year. For example, Transnet, as well as Eskom, a couple other initiatives, right? Like the visas, for example, for tourism. So there is perhaps slightly better prospects going forward. Also do think if the commodity prices hold, I obviously have also see through in the economy, and perhaps we'll see GDP numbers can be eked up next year. But this year will be very difficult, and you can see the company guidance, and when you engage with management teams, they are pretty much just trying to keep costs as tight as they can and trying to eke whatever growth they can. But it's very, very difficult.
And this is very interesting because, I mean, I know that Bidvest is seen as the bellwether of the economy, but for the longest time, it had been outperforming the South African economy. I don't know, is this testament to the fact that, Shane, at some point, the economic woes will catch up to you?
Zanati, yes. I mean, just to touch on what Alex said, historically and globally, you've needed two things for positive economic growth. You've needed freely available capital, which generally means low interest rates, and you've needed low energy prices. If you can overlay freely available capital and low energy prices, generally you have good growth. However, in South Africa, we have an additional factor, which I think is the retarding effect of, let's say, the state-owned entities and government legislation. And I think those factors, it stifled our labor market, it stifled our transport infrastructure. I mean, we know what's going on at Transnet. We know what's going on at Eskom, although I have to say we've had 105 days without load shedding. But my point is that everywhere else in the world, all you need is cheap money and cheap energy, and you're going to have economic growth. In South Africa, we have some structural problems that make it hard to grow.
It's quite interesting, Alex, because I know with a lot of these companies now, you know, the economic headwinds are catching up to them, and you can really see that filtering through to their numbers. But it's quite interesting that Bidvest has been taking the plunge that it's been taking, not even just today, but actually, it could be most of this year when companies, for example, like Italtal, investors are plowing into. Would this not be the time to get into Bidvest when everybody seems to be running for the hills?
Yeah, I think that the reaction today is a little bit too much. So if we look at Bidvest results, it was well expected that earnings growth rate for this year would be very muted, like 0 to 1 or 2%. And prospects are probably better. If you look at this breakdown of the sort of results, it's mostly in South Africa where they've gone a bit backwards, specifically freight and some of the other commercial aspects of the business really struggling. But they've been investing a lot in offshore. So that just changed the business compared to previous cycles. So you've got some capital allocation risks. It's perhaps not as easy to understand those businesses compared to what we've got in South Africa. And obviously the balance sheet is also being geared substantially. So that does introduce some risk and perhaps investors' appetite a bit less than it used to be. But it's still a very good business if you can buy it at the right price. We did think Bidvest ran far ahead of its valuation 6 or so months ago. Current levels start probably looking a little bit more interesting to us. But just to get to your question also on something like Italtal, Italtal is trading at pretty much at the massive discount to its history. It doesn't have any debt. It's got actually quite a big net cash position. Announces massive special dividend. So you could probably argue that that's a pivot has happened there, and they're probably looking more interesting way at Bidvest, a bit more complex to understand when exactly a pivot will happen there. But looking more interesting perhaps than a few months ago.
All right. Well, I mean, with Truworths, they released, of course, their numbers at the end of last week. And, of course, that stock took quite a beating. Interestingly, though, I think on the same day or the day after they came out with their numbers, we did get a notification from Norges Bank that they acquired more stock in the share, seeming that they were maybe taking advantage of the knock that the share price took. Shane, your thoughts on how Truworths performed, and maybe just the kind of interest that some people then would be showing on Truworths?
So, Zanati, Truworths is very cheap on current valuations. I would say, about an 8 PE forward. They have a balance sheet that has no debt whatsoever. And then they have two businesses, one in South Africa and one in the UK. The South African business is not growing at all. The revenue is either flat or going backwards. The UK business is growing very well. The UK business is a footwear business. It's called Office. It's a very high quality operation. I think what has happened to Truworths is that fundamentally, fashion retailers need to reinvent themselves every 5 or 10 years. And I feel like if you look at Truworths, it's the same management prosecuting the same strategy with less good results because people maybe are no longer interested in their offering. And at the same time, the market is becoming more competitive, both with bricks and mortar retailers and with online retailers. So Truworths just needs a reinvention. But I would say that a lot of the bad news is priced in. It's just simply too cheap. It's come a decent dividend, 2-3 rand, and on top of that, they're going to do a share buyback. So we actually buyers at the 60 rand level.
It's actually quite interesting that you talk about Truworths needing a reinvention, because it would seem that it's a trend in a lot of the apparel retail stocks, including, for example, even Woolworths. We know that Woolworths is struggling in terms of the clothing side, but really pushing through with the food. How's the apparel retail space looking for you at this point, Alex? Because we've even seen investors being unhappy with Mr. Price results and generally the retail numbers across the board.
I mean, the South African consumers are under tremendous pressure. You can see it in the bank results, you can see it in the consumer-related stocks. And even if you look at companies like well, it used to be called Whole Choice, Home Choice Weaver, where there's buy now, buy later products. I mean, those are indications that consumers are cash strapped if you use products like that, right? So we are in a cycle where some retrieve is required for us before we can start spending again. So I'm not surprised by the numbers, but saying that, going back to Truworths, I concur it's just too cheap at these levels. Also, because of their strong cash generation, it's very, very likely they're going to start share buybacks again soon, because the big capex cycles also come to an end. They spend money on the DC there. So I think it's probably close to the bottom now. Valuation looks cheap. It's difficult to see growth, yes, but even though management is perhaps stated in the way they do things, we do know they're going to run a very tight ship there. They did state that, you know, credit granting at the moment perhaps a little lower than it needs to be, and they perhaps open taps a little bit. And they also had a very high base in office, so things, you know, apparently the base is a bit lower going forward. So I think there's some green shoots for those that are willing to take a bit more contrarian view on Truworths.
All right. Before we go to the break, Shane, you mentioned a development on Valterra Platinum. Just walk us through that at the moment.
Yes, Sonati. So Anglo-American have sold down their stake in Valterra. It used to be called Anglo Platinum. They've sold it down from above 70% to 20%. So they still own 20% of Valterra. In that sell down, they agreed to a lockup period where they would not sell down more in the market. That lockup period expired on Friday. And we think that Anglo-American is likely to place this stake in Valterra sooner rather than later. It's a big event because 20% of Valterra is in the order of a 40 billion rand equity placement. But, you know, you can see that precious metals are doing very well at the moment, and I think there's appetite for Valterra. And I think Anglo-American are under pressure to show that they are executing on their strategy. You'll remember that the sale of Peabody, their coal mines in Australia, fell through. And, you know, my experience of management is that they do the things that they are able to do sometimes. And this is a transaction that Duncan Oneblood is able to do. And if we're dead honest, he needs to show some progress. Investors are fed up with underperformance at Anglo-American. And I think the sale of Valterra will pay down their debt, and it will raise the free float of Valterra, and in some sense, it's good for everyone.
Could we expect maybe a little bit of pressure on Valterra?
Well, you know, people may pre-position so they can participate in the placing.
Okay.
But I think generally people are trying to get longer precious metals, not shorter.
Okay.
And so I think a placing will be used by a lot of people to upweight their precious metal exposure.
All right. More questions. Of course, we ended off that first half with commodity stock. Now we're going into Exxaro. What is the expected share price for Exxaro in the next 12 months? I think you're going to have to bring out your crystal ball there for us, Alex. I've had the stock for almost a year now, and it has been down most of the time. Not sure if I should hold a bit longer or sell at these prices. Did Exxaro have a good day just now when they came out with their numbers, Alex?
Crystal ball, so I'm not going to give a previous forecast, but we are constructive on Exxaro. We bought a few months ago. Get a bit lucky of our timing there, but certainly the results were better than we anticipated. You know, pretty much when the change of management happened there with Ben Magara coming in before, that was perhaps not a bad time to buy into the business. So also the big risk ahead of the manganese or potential asset they were going to do is now known. We know they're going to buy the manganese assets. And they're also going to change the capital structure now, meaning they're going to keep less cash on balance sheet going forward. And that's a positive, because that means I will have higher returns and perhaps even better dividends going forward. I think the key for me is if you look at the Exxaro broker expectation a few months ago, everyone's expecting earnings to go backwards. But pretty much now, it's even though growth will be muted, they're expecting positive growth. And considering the high dividend and potential special dividends to come, well, not special dividend, but more dividends to come in the future, and a bit more constructive view on specifically coal export market. We're seeing thermal coal prices picking up a little bit. They're doing well with Eskom, and of course the manganese assets and so forth. So I think investment cases slowly but surely starting to come out. It will never really trade on similar valuations compared to other diversified miners because of the coal exposure and so forth. But relative to history, we think that discount is perhaps still too wide, and there's perhaps a few more another 10-20% that perhaps can be unlocked there if the status quo holds.
That's actually an interesting point that you bring up, Alex, that it will never really trade at the valuations of other diversified miners. And of course, Shane, people are generally more constructive on the other diversified miners. Would this be one noting and maybe including in your portfolio of diversified commodity counters?
Listen, this is a smaller South African listed commodity producer. It is coal and iron ore, now manganese. I think that it can't really trade on the ratings that the big global diversified miners would trade on, such as Glencore, because it's fishing in a smaller pool with a narrower product range. But as Alex said, the big difference between Exxaro now and Exxaro 18 months ago is that Ben Magara has come in to run the business, and he's a very talented manager, and we think very highly of him. And prior to him, I think it's fair to say that Exxaro had management that were simply not competent. They've had some of the worst management I've seen. And I think Ben has come in and tried to tidy up what is going on in the business and to focus the strategy. And I think he's doing a great job. They actually have pretty good assets, really. You know that their largest asset is their investment in the Sishen Iron Ore Company, which is really Kumba. And that's a very high quality iron ore asset. And Exxaro now, even after the run the share price has had, probably trades on about a 5 or 6 PE and a 15% free cash flow yield. So, sure, I think the easy money's been made, but if Ben keeps working his magic, I'd say there's still some upside.
All right. Well, very interesting comment here. The viewer says, what was your key market learning last week in the share market in terms of what to do and not to do? Mine was be careful selling at bottoms on Curro. And of course, we know that Curro had been under pressure for a long time until that announcement we had last week. Alex, your take there?
Look, I mean, I think you shouldn't be too harsh on yourself. I mean, corporate action you can sometimes expect. But in case the corporate action here was, for me specifically, came out of the blue. We know that Curro has been struggling operationally. They've been unable to grow the number of learners. And one of the big reasons for that is the affordability. So I spoke earlier about consumer being under pressure. So Curro obviously targeting that, call it mid-LSM consumer. And even though there's an insatiable appetite for private education, the ability to pay is not really there, right? So that market is struggling a little bit. They've been very aggressive on fees as well, and that perhaps has had an impact on learner growth. But getting back to the, being bought out, you could not have foreseen that. So now my question is, how is that going to impact the private education space going forward?
Yeah.
Because now you're going to have this very large non-for-profit operator. So it could have a negative impact on some other schools. But time will tell, but it's something to think about.
Shane, did this kind of pique your interest then in the private education sector, particularly maybe as to what will be left on the JSE? Just your take on that.
Zanati, I think it depends what the true motivation of the Mouton family is. If they have a completely altruistic motive and not a financial motive, then there's a fantastic transaction for the country, and it's wonderful that a wealthy family like that is doing something. But the reality is they're funding it by selling Capitec and PSG, and Capitec and PSG must be in the top 20 highest quality companies on the JSE. So in some sense, you could accuse them of pruning their roses and watering their weeds, But, if it's altruistic, well then, congratulations to them. But financially, it doesn't make sense, in my opinion, given the quality of the assets they're selling.
Yeah. All right. Yeah, very, very interesting. Well, let's go into food production. RCL Foods coming out with its year-end results today. Very interesting what we're seeing there. I mean, earlier on we were talking about a consumer that is under pressure, and we saw a tepid rise in revenue there. But actually, quite interestingly, the bottom line rose by double digits, and it's quite interesting that they spoke of volume pressure across most categories. Alex, what would you say about RCL and I guess the general food producer sector on the JSE?
All that you say, there's once again another evidence that the consumer is under pressure with declining volumes and quite a tepid revenue growth. The results were quite good because they were able to expand margins. So both the groceries and the baking division margins expanded, while the sugar actually contracted. But I think this is a better quality result if you look at the breakdown of the earnings compared to previous year, where sugar was much higher component of earnings. But it's unsure how much more they can, I guess, expand margins with no revenue growth. Because remember, if you don't have revenue growth and your cost base continues to run ahead, that means you've got negative operating leverage, meaning your expenses are outpacing your revenue. So that is a challenge. So I'm not too sure how much more they can do that in that regard. But certainly RCL's results have been ticking up a little bit of late. You also see it in Rainbow Chicken, which spun out of RCL. And they also made quite a nice recovery, and they actually gave very good results last week. So I think they're perhaps well positioned, but we need economic growth for them to really do well. There could be corporate action, of course, at RCL. There's always rumors of corporate action. I mean, remember, Ramgrow owns over 80% of the business. So free flow is quite tight. And there's always, I guess, potential deals that you need to look out for. But I think that will be the real kicker if you want to be invested in RCL, is to expect some economic growth and potential corporate action.
It's quite interesting because even with AVI, for a long time, there have been murmurs of potential corporate action. Shane, is this be something that is on your radar in terms of that food retail sector? Do you think maybe we could see some sort of consolidation there?
Yeah, Zanati, I think so. The food sector actually, as 5 years ago, was very badly managed. And now I think the sector in general is very well managed. I think that chart coming into Tiger Brands has fundamentally changed that business. I think we all agree that Premier is very well managed. And I think RCL, now that they've split out the chicken business, also seems to be doing better. But the main benefit that these companies have is that commodity prices are lower. The sugar price is down 6-7% year to date. The wheat price is down 10% and the maize price is down 11%. And so their input costs are all lower than what they were a year ago. So despite the consumer being under pressure and their selling price inflation maybe not being there, they do have lower input costs.
All right. Well, James, let us get to where you are seeing opportunity today. Your stock pick, Alex.
Yeah, so with PGM rally at the moment being quite aggressive, we still remain constructive on it. I thought I'll give the viewer something different today, and that is the Rhodium ETF. So when this market is particularly tight, so we know small changes in supply and demand could cause a big spike in it. As it's a very geared play on a PGM basket. And we're seeing, of course, palladium is catching up. Down palladium has done quite well thus far. And with the high emission standards, I think China 6 and so forth, we could expect high demand for rhodium going forward. And because of their tight fundamentals, it could really leap. So if you look at the previous cycle, 2017, 18, 19, rhodium really shot through the roof. I'm not saying it's going to happen again, but it's something to consider if you are bullish on the market and there's very big tightness in supply.
All right. Shane, what are you betting on today?
Nati, when I started out my investment career 30 years ago, they told me the only good time to buy a gold share was when you're covering a short. So with that as broad context, I'm punting Harmony Gold. And the reason is that I just think the gold market is constructively set up for all the gold majors. There are many reasons. We've got the central bank buying by China, by Saudi Arabia, by India. We've got global political uncertainty. And then the main impetus is we have the hostile takeover of the Federal Reserve by Donald Trump. And this has created uncertainty over what is the value of US treasuries, which is the largest asset class in the world of financial assets. And it is causing money to run into safer assets. and one of them is gold. And there's obviously a limited supply. And in general, most investors are underweight mining and gold mining. And the gold and the platinum sector together now, with the unbundling of Valterra, are nearly 20% of the JSE. So it's gone from being a sector that you could ignore to a sector that you simply cannot ignore if it goes up and you're underweight.
All right.
And then I think Harmony have very good South African assets.
All right. Very, very interesting insights there, gents. Thank you so much for your analysis today. Really appreciate it. That is all for Stock Watch tonight. Thanks to our guests, Alex Duys from Umthombo Wealth and Shane Watkins from All Weather Capital. Up next, The Close. Stay watching.